Hello everyone. This video provides an overview of the chapter budgeting example problem number 2 from chapter number 11. Before continuing on with the video, I suggest that you pause the video for a few moments and review the setup of the problem on page 334 of our textbook in regard to the Supreme Shoe Company. Let's take a look at the setup for the problem. Notice here that the problem states that has our information provided in 3 columns. The first column is for the old existing machine. We have the new machine as well as the differences between the two alternatives. In the first column, it tells us that the old machine originally cost us $40,000 5 years ago. The important part of this is to recognize the price of the old machine that was paid as a sunk cost. A sunk cost is a cost of which has been committed, and no matter what alternative is chosen, that cost can never be recovered. So this $40,000 should not factor into our analysis. Comparing that to the price of the new machine, of which is very relevant to our problem, is $35,000 or $75,000. The shipping and installation of the new machine needs to be factored in, and that will factor in as to the book value, or $81,000. The original life of the old machine was expected to last 10 years. That was bought 5 years ago, so we still have 5 years of life on this machine. In regard to the new machine, new machine is expected to last us for 5 years. If in the case that we purchase the new machine, we are going to be able to sell the old machine for $22,000. So even though the price of the old machine is no longer relevant, what is relevant to the problem is that we can sell it for $22,000. And the current book value, the old machine was depreciated from $40,000 down to $20,000. So if we sell it for $22,000, we will have a gain of $2,000. It's important to recognize that gains and losses have a tax effect, and so therefore, even though we will have a benefit of $2,000, that benefit is, or the cash flow of $22,000, $2,000 of that is going to be taxed at 34%. So we need to factor in the tax consequences of a business decision. In addition, the problem tells us that we are going to have to increase our inventory by $3,000 to sustain the additional production capabilities of our machine. So we're going to have an additional $3,000 of cash out to get the new machine up and running. Notice here that we have depreciation for the old machine compared to the new machine, is the difference being $9,200. That additional $9,200 of depreciation is going to save us a little bit of taxes, so we will factor that into our analysis as well. The old machine requires an operator, of which we pay $29,000. The new machine is fully automated, so we're going to save $29,000 per year. Maintenance used to cost $6,000. New machine will only cost $5,000. So we'll save $1,000 on maintenance, and we'll save another couple $1,000 on on defects. One last thing to note here is that the required rate of return is 15%. Notice that within the setup of the problem on page 334, it tells us that in order to buy the new machine, we would need to borrow $30,000 at 10% interest, resulting in interest expense of $3,000. We will not factor in that $3,000 because it's assumed that when we evaluate this at a 15% required rate of return, that 10% interest is already factored into this required rate of return. If we added an additional 10% interest, say on $75,000 plus a required rate of return of 15%, it would be like saying that our required rate of return would be 25%, and that's just not reasonable. So therefore, the required rate of return of 15% inherently already factors in the 10% interest that we are going to pay. So let's take a look at how our cash flows are going to lay out. First off, we have the initial outlay. I think rather than working through this the way our author does, let's go ahead and calculate this in a different way. Let's say initial outlay. And the initial outlay is going to be equal to the price of the machine. And the way I think I'm going to go ahead and indent that just a little bit. And let's go ahead and copy that over. And so we know that the price of the old machine, that's not relevant, but the price of the new machine is what we want to factor in. So let's just go ahead and leave it there. And notice that left justified it. Let's go ahead and take that back to a right justification. In addition to that, the shipping and installation. And I'm going to copy that over as well, but I'm going to delete what's in the column for the old machine. And all we're focusing on right now is the cost of getting this project up and running. Okay, in addition to that, we said that we would have to increase our inventory. So equals the increase in raw materials, 3,000, and I'm going to delete the 0. However, we said that relevant to our decision is we can sell the old machine for 22,000. So let's say less the salvage value of old machine. So we're going to say minus 22,000 and hit enter. But in addition to that, we said that the difference between the $22,000 and the $20,000 book value is going to result in a $2,000 gain, and that gain is going to be taxed at 34%. So that's going to be something, an additional amount we're going to have to pay Uncle Sam on our taxes. So let's say plus taxes on sale of old machine. Okay, so the taxes are going to be equal to, in parentheses, the 22,000 minus the 20,000, close our parentheses, times the tax rate of 34% and hit enter. Now let me go ahead and I'm going to go ahead and change all of this to comma formatting and reduce the number of zeros. Now I'm going to all at the same time indent these items, and so now we can say the total initial outlay is equal to all of these items of $62,680. Let's go ahead and add a little additional formatting, maybe the top and bottom border, and there we have it. Okay, so our initial outlay is $62,800. Now, the way our authors lay this out, we could also do this in a single cell. I just wanted to lay it out this way, but in a single cell is equal to the $75,000 plus the $6,000 plus the additional $3,000 minus the what we're going to get back, or the salvage value, plus the taxes. So we need to say plus in two parentheses the 22,000 minus the 20,000, close our first parentheses, times, and click on the 34%, and close our parentheses and hit enter, and we have $62,680. Okay, so hopefully this helps to explain this item up here. Next we have our after-tax annual tax, the annual after-tax cost savings. Well, up here we said we would save 29,000, 1,000, and 3,000. So our savings is going to be equal to the auto sum. We can click on our auto sum and simply highlight these items. Okay, that's going to be our pre-tax savings, annual savings. It's important to understand that if this is how much we're going to save annually, that is going to result in a profit of $32,000. However, on the $32,000, we have to factor in the 34% in taxes. So let's go ahead and then multiply this, multiplied by, in parentheses, 1 minus the tax rate. So in effect, we're saying the 32,000 minus the 34% in taxes is what we get to keep. So notice here, that's really quite a big difference, that we're saving 21,000, we're saving 32,000. However, Uncle Sam is always going to take his share, and it's a very, very important part of any major cost saving decision that involves additional machinery or costs to initiate. Okay, so in addition to that, we will have a tax benefit. We're going to have an additional $9,200 worth of expenses every year. However, that will save us in the amount of taxes that we pay. This isn't cash out, but what will be cash out, or how much we're saving, is 34% of this amount. So equals a negative is a positive, multiplied by 34%. We will save an additional $3,128 because of this depreciation up here. And so therefore our total annual after-tax cash flow is going to be the sum of these two items. So click on Auto Sum, highlight those two items, and hit Enter. Now then, the project tells us that at the end of 5 years, we can sell the new machine for $15,000, but in addition to that, this $3,000 of extra inventory is going to be able to be sold to generate cash. So therefore, the terminal cash flow is going to be equal to, we're going to sell this new machine 5 years from now, is the assumption, plus the $3,000 in additional inventory that we can liquidate. One of the things, notice here that on this $15,000 we are not factoring in the additional tax. The reason for the sale of this item, the reason for that is that if we use straight line depreciation like the problem tells us and set it up the way it is that the book value would be equal to the salvage value of $15,000, and therefore there would be no gain or loss. If there happened to be a gain, then that gain would be taxed at 34%, and we would need to factor that into this terminal cash flow. If there happened to be a loss, that would result in a tax savings, which would then bolster this terminal cash flow. But in this case, since the original salvage value is going to be equal to the book value, and we're assuming there's no gain or loss, then there is not going to be a tax impact. So therefore, our cash flows in time period 0, 1, 2, 3, 4, and 5, in time period 0, to get this project off the ground, is going to be equal to a negative or minus $62,680. Our annual after-tax cash flow is going to be equal to the $24,248. Let's go ahead and put absolute referencing around this item and hit Enter. Now we can just go ahead and copy that down through time period 5. But also note that in time period 5, along with most projects, are going to have some type of terminal cash flow. So let's go ahead and type into our formula bar plus the 18,000 and hit enter. So in the last year of this project, the project should have a $42,000 or an additional $18,000 cash flow in that year. Okay, the next thing we want to do is, now that we have all of this factored in, let's go ahead and take this to our next tab called the Analysis tab. And notice here that our required rate of return is equal to, if we click back to our first tab, our required rate of return is 15%. And so because this automatically encompasses the interest rate, we can't double count the interest. Our projected cash flow is going to be equal. Click back to the first tab and click on the negative $62,680. And let's go ahead and copy that down. And now then, we need to calculate our present value of each of these cash flows. If it costs us $62,680 today, the present value of that today is equal to a negative $62,680. Simple as that. However, $24,248 1 year from now, discounted at 15%, we know is not equal to the 24. What is it equal to? Let's go ahead, click on our insert function and click on present value, enter PV, enter 2 times, and our rate is going to be equal to 15%. The number of periods is equal to 1, and the future value is equal to 24,248. And up here in the rate, let's click back in there and hit the F4 key to get the absolute referencing. And once we do that, we can go ahead and copy this down through time period 4. In addition to that, let's go ahead and change these amounts, because inherently a present value from a positive future value is a negative. Let's change that to an absolute number and type in a negative in front of the present value and change that. And then let's go ahead and copy that down one more time. I'm not making sure that I did that correctly. There we go. Next then, let's go ahead and calculate the cumulative cash flow. The cumulative cash flow is equal to the 62,000 equals the 62,680 minus the 24,248. Hit enter. Let's go ahead. Oh, that should be a plus. Excuse me. So once again, equals the 62,000 plus, I said minus, but plus the 24,000. Let's go ahead and copy that down. And then let's call this, let's see here, I'm going to use my format painter, and then cumulative cash flow, and let's call this the cumulative discounted cash flow. Okay, there we go. Is equal to, and I'm going to click on the present value, then equals the 62,680 plus the 21,850. Then go ahead and copy that down. Okay, so our payback on this particular project happens to be equals, notice that the payback is going to be achieved sometime between year 2 and 3. So the 2 plus, in parentheses, minus the negative is a positive, divided by the cash flow in the year following achievement of payback. So in year 3, cash flow in year 3, close our parentheses, 2.6 years. Our discounted payback, notice, is sometime between year 3 and year 4, because in year 3 and 3/4, between year and 3/4, is equal to year number 3 plus, in parentheses, negative, click on the negative 7,000 divided by the cash flow in the year following payback, close our parentheses and hit enter, 3.5 years. So equals 2.6 equals 3.5. Okay? Now, continuing on with our net present value, notice here, if I was to total all of these items, that's going to equal the net present value that you can see down here, 27,552. But let's use our NPV function. Use our insert function, type in NPV, and hit enter 2 times. Our rate is 15%, and our values, go ahead and highlight them and hit enter. And once again, we said that it was supposed to be an amount difference, so in Excel, NPV doesn't work as it should. So let's go ahead and click into the formula bar. Let's go ahead and enter in times, in parentheses, 1 plus the required rate of return, close our parentheses, and hit enter. Okay, so there we have it. Our net present value is indeed equal to the 27,552. Our internal rate of return, type in IRR, hit enter 2 times, simply highlight the values, hit enter, and our MIRR, modified internal rate of return, there I had it up already, and so I'm just going to highlight the values, but now I need to identify the financing rate as well as the reinvestment rate. That's the one big difference, is with the modified internal rate of return you can redefine the reinvestment rate, while with the internal rate of return the reinvestment rate is assumed to be at this IRR. But in this case, we're going to change that to 15%, which causes the modified internal rate of return to be a more realistic 23.7%. Now, just in quick review of this problem, remember that at the end of the setup on our problem on page 334, it said, furthermore, management has determined that the maximum allowable time to recover its investment is 3 years. Notice that our payback is 2.6 years. Based simply on that statement, we would call this an accept decision. However, furthermore, continuing on, anytime a project has an NPV of greater than 0, it's assumed to be an accept decision. In addition to that, with the internal rate of return and a modified internal rate of return of which is greater than the required rate of return, that too points to an accept decision. This project definitely looks like a go to me. Okay, that concludes this very quick overview of replacement analysis, and includes some of the important concepts of tax consequences and how taxes need to be factored in. It also included the concept of how a sunk cost should not be factored into a decision, and in this case we had the sunk cost of the $40,000, as well as, gosh, I think there was another sunk cost in here somewhere. But in addition to that, there was also the 10% interest. Because we're running through this, our analysis, and we have this required rate of return, that 10% interest is initially assumed to be part of this item here, and we need to ignore that 10%. However, if you were looking at simply a payback period or something like that, then that you might want to consider the interest. But if we're factoring in or using the net present value, internal rate of return, or modified internal rate of return, the interest on a loan is inherently built into the 15% interest rate or required rate of return. One other thing pointing out, now I found that other sunk cost. Notice that it says within our problem, it stated that the company spent $5,000 on a study to examine whether or not the facility could support the additional machine. That $5,000 too would be a sunk cost, of which is non-recoverable regardless of the decision, and should not be factored into this decision. Okay, I hope you found this overview helpful, and that concludes this